Hello and welcome to the Friday Market Update with Invest with Rules. I'm Scott Bennett with Mike Olafson. It's Friday the 13th. We're going to cover how would the trend roadmap have handled the 1929 stock market crash? Kind of all of our biggest fears. Mike, let's talk about the trend roadmap and how it would have acted in the 1929 crash. What do you think?
Yeah, and we're doing this on Friday the 13th. How lucky you feeling, Scott?
You feeling lucky. So very simply, the IWR trend roadmap is we're going to show kind of you had the roaring 20s. And then you had the worst crash in stock market history. It's the Great Depression, peaked on September 3rd, 1929, and then followed by an absolute nasty bear market. And then the final market low came on July 8th of 1932. So here's a chart, and let's have Mike kick us off. We're going to look at the trend roadmap, and we're going to go back in the time machine. If you don't mind talking about the data and what you see.
Yep. So first off, let's talk about the data. So this is data that we scraped off of the interweb where it's a simulation of the S&P 500, very closely approximates the Dow Jones Industrial Average, but a bit broader. So the trends and data are very similar to what you see in the big chart versus what we did in the trend roadmap to do the actual analysis. So with that said, we're going to show you three screenshots of the trend roadmap. The first one is let's go back to the summer of 1929, roaring 20s. Everybody's happy, having a great time, spending time on beaches, all that kind of good stuff. And the market's going nuts. It's capping off about 100, basically 100+% uptrend. Just amazing over the last couple of few years using the long-term trend. So everything's looking great. Now let's work forward the next 60 days. Now we're heading into, we all know now in hindsight, the crash was on October 29th. But now we're putting ourselves in the fall, beginning of the fall of 1929, and we're seeing how the uptrend's continuing. But then there's some cracks that are forming. We get a coast showing up. We then get sustained coasts going into the end of September where that arrow is. And you kind of see something's going on. So not selling yet. We're still on that gas signal. We're selling on a break, but let's go to the next 60 days. Now we see the coast is sustained. We hit a gas, then some more coast. So definitely cracks showing up. And then we get the break in October, about 5 days before the actual crash. So that arrow shows you that the break hit. Gut check me here, Scott. That's October 23rd, right?
Mhm.
Yep. October 23rd is when we hit the break. So we're doing that buy on gas, sell on break. We are liquidating, going to cash. And then all hell breaks loose. So then flip to the next one, Scott.
You bet.
This now, let's zoom back out again. We saw the lead up to the crash on October 29th, and you could see this on the large chart that Scott showed us a couple minutes ago. You could see that break happening in late October, and that's shown if you go up to that, if you could point, there you go. Thank you, Scott. That's the break signal. Interestingly enough, the original crash on October 29th was only a first telltale sign. The market actually recovered, as you could see, where that break signal ended up only being a 4% downtrend on the long-term signal. We actually hit a small gas where we dipped our toes back in the market, lost 4%, not a big deal. And then we got another break in late April of 1930. Almost, actually, yeah, about 7 months after the original crash. And that's when truly the dam broke. And as you could see, we then sustained a 70+% long-term downtrend. And ultimately, like Scott said, the market lost 89% from peak to trough. And then you can see in 32 at the kind of in the summertime frame, we got the first gas signal, which showed that the market was actually coming back out of this awful crash.
Yeah.
Scott, anything you'd add?
It should be noted, obviously noted, that we weren't alive during this period, that this is a back test, that
Yes.
this is how our process would have worked in a back testing scenario. So please note that we weren't running money or a newsletter or alive at this moment in time. So just this is we want to go back in the time machine to show, not to prove that everything works, because nothing's perfect. There's little tiny cuts like a -4, but the main premise is do we have a mechanism or a process to avoid a -71% crash and not sit through this and just keep saying to ourselves, it's going to come back, it's going to come back, it's going to come back, and you're in the Great Depression hypothetically. Yeah, it came back, but it took almost a decade. And how miserable would that have been losing? Just mentally think about it. What if you lost 70% of your capital? Like, holy smokes, right? That's like totally life-changing. Go back to work longer, like nightmare. And I'm not saying it's going to happen next week or the week after. I'm sure there's enough people on YouTube or podcasts that will shake us up pretty good with those like headlines, like, here comes the crash. But like, do you have a mechanism that will alert you when things are horrible? And will you get off the highway when you should be like you shouldn't be going in the left lane despite 100 years of data? You should be moving to the middle lane of the highway, the right-hand lane of the highway, and getting off the highway when the market loses 70%. Any final comments before we wrap on the market crash using our trend roadmap backtest?
No, I think you summed it up. And yeah, bottom line is small losses, big gains, as this chart shows, that big gain coming into the small loss, and then being totally okay with cash when the trend is working against you. So I think that's really the bottom line.
Awesome. And if you do have, just as a side note, obviously, please manage your risk tolerance, manage your financial plan, use stops. This is not financial advice in this capacity. It's just information. So please always note that's incredibly important as we're about to show you our live sheet. And if next week we're going to be planning to open up the membership to any new members. So if you have a friend or a family that you want to be kind of in this together with, kind of a partnership. Obviously, we would appreciate if there's someone out there that like this is important for them to be a part of their investment process, just be on the lookout. Go to investwithrules.com. But moving forward, we'll do this just for members. So the stock market score, 9 out of a 10. It is deteriorating, but it's still really strong. There's a lot of consensus that the Fed should cut interest rates one more time in December and then potentially hold off. We'll look at those statistics as the world moves on. Finally, the $1 billion fund manager report, which is ever moving. Obviously, we knew the funds were buying Broadcom, Avago. It's hard to get an entry when it's just right before earnings, but obviously a sweet day today. We have our eye on the stuff at the top. We want it to show up in our watch list. That's our lower risk protocol, but we're watching this closely. But I would say the big tell, November was amazing. 10% return for the month. This is not shocking to see December deteriorate, and you'll see the S&P and a growth allocation head to the top as the market's pulling back. So this is normal. This is a normal thing for growth stocks to get hit when the market's trying to figure out, is the Fed going to keep cutting rates or not, and where does that stand for the cost of capital? So in general, we're watching this closely. It's not a great sign that there's very few stuff doing well for the growth stock market, but we have a mechanism to at least tell us that versus us just kind of go based on gut feel. So I'm going to stop there for final comments, Mike.
Well, on the December report, this one snapshot and what you just went through, Scott, will put all of us ahead of 95% of investors out there, because just understanding that the indexes are kind of holding up and they're masking some of the weakness, especially in growthier stocks that this report shows, is really a key thing to understanding that, hey, the market's got some cracks in it and we will just follow the trend.
I want to say thank you. If you have questions, email us hello@investwithrules.com. Have an amazing Friday weekend. Try your hardest to stay away from the screens and enjoy your time. Again, thank you for being a member. Talk soon. Bye bye.